everyone, and welcome to the Founder Institute event on how to raise money for your business. This is a very popular subject for founders and business owners around the world who are looking for funding. My name is Keshni Morar, and I'm a director at Founder Institute South Africa and your hostess for this evening. Tonight is our first event in a series of events leading up to the accelerator, which launches in March 2022. Founder Institute is the world's largest pre-seed accelerator in the world, with presence in over 90 countries and 200 cities, with a network of over 20,000 mentors who have helped our 5,000 alumni raise over $1 billion in funding to date. One company who has gone through the program, which you may be very familiar with by now, is Udemy. They've recently IPO'd on the NASDAQ Stock Exchange. One of the things that I'm absolutely proudest of being part of this prestigious network is the quality of mentors. And tonight, I'm joined by three of them, three amazing people whom I have tremendous respect for as they invest their time and energy into growing entrepreneurs. So if you're a startup founder and have global ambitions and would like to be backed by the largest startup organization in the world, we have open admissions to our March Cohort 2022, where we can help you get traction. For more information, please visit fi.co/join. Tonight's topic is focused on how to raise early stage funding for your startup. I'd like to give a shout out to my fellow directors of Founder Institute South Africa, Jacobus Erasmus, Lavina Ramkisun, and Pumzile, who will be manning the chat and the QA this evening. So if you've got any comments, drop them in the comments section below, in the comments box below. And if you've got any burning questions for our speakers, please drop them into the Q&A. A very special thank you goes out to Jitesh Jairam from the Boardroom in a Box, who is assisting us on the webinar production for tonight, and Kobus van Zyl from Mesh Club in Rivonia, who has opened up his venue to us as a venue partner. Before I go around the room virtually and ask our panel to introduce themselves, I'd like to share the agenda for this evening. We'll kick off with an introduction to our speakers, followed by a presentation by Nivesh Patha of Newtown Partners, who will be presenting our various options to funding, followed by a panel discussion with them. I encourage you again to pop any of your comments into the chat and QA into the Q&A box, which will be answered during the Q&A session that follows. At the end of the evening, I invite you to join us for a networking session on the AirMeet platform, where you will meet our speakers and local directors and have candid conversations around funding. So Zizipo Nyanga of Ubank SA, would you mind introducing yourself and telling us what you do?
Thank you, Keshni. I'm so grateful that you asked us to introduce ourselves. I'm sure my panelists will agree with me. It becomes awkward when someone is introducing you and you want to dig a hole. My name is Zizipo Nyanga. First and foremost, I'm a mother, I'm a wife, I'm a daughter. I am also a chartered accountant by profession. I work for Ubank as a chief entrepreneurship officer, driving access to funding and helping entrepreneurship grow in South Africa in general. I'm also an entrepreneur at heart, and I really am excited to share insights and to also learn from this session.
Thank you so much, Zizipo. Nivesh Patha, if you could come up.
Sure, thanks, Keshni. Good evening, good afternoon, everybody. My name is Nivesh Patha. I'm an investment principal at Newtown Partners, which is a US VC fund manager that invests globally and into Africa. I also work for an organization called Launch Africa Ventures, which also is a premier pre-Series A VC fund. Yeah, from an academic background perspective, I'm also a chartered accountant and CFA charter holder, but I spend most of my time, what I'm passionate about is assisting globally scalable and innovative businesses that are solving really critical problems. So yeah, glad to be here and looking forward to the discussion.
Amazing. Thank you so much, Nivesh. Pomi, last but not least.
Hi, everyone. Thanks, Keshni, for giving me this opportunity to share some of my insight and experience. Hi, guys. My name is Pomi Lachman. I'm a self-made entrepreneur, started out my own business, literally from nothing just over 18 years ago. And along the way, have done a bunch of mentorship and started other companies and started other avenues of business. And hopefully, I want to share some of that experience, knowledge, and pain with you through the rest of the session.
Thank you so much. Thank you again to our lovely speakers for joining me tonight. I appreciate your time and I appreciate your knowledge. I'm going to call up Nivesh, if you could bring up your presentation. We're going to get into that next. Just a little of my experience with Nivesh. I know he's presented at a number of investor events, and he's quickly established himself as a thought leader in the venture capital sector. He is one of our highest rated presenters, and I'm looking forward to this. And I'm sure, as everyone is, he's got a wealth of information we want to get our fingers on. So, to you, Nivesh. Thank you.
Sure. Thanks, Keshni. I can't say that I agree that I'm an expert, but yeah, happy to kind of share as much info as I have, and guess just kind of give the context of myself and the learnings that I'm going to be sharing with you today is just, like I said, I'm a venture capital investment professional right now, and I work for a company called Newtown Partners. And just to give you the context of Newtown Partners, so we're a USVC fund manager that's based in San Diego as well as in Cape Town. It was started by our two GPs who are both successful entrepreneurs, Vinnie Lingham and Luke Clausen, who've had multiple exits and then transitioned into angel investing and then formalized it in a VC fund structure. Just for a quick overview of our mandate, we typically invest into the healthcare, logistics, supply chain, and blockchain technology sectors. We prefer B2B technology-led or enabled businesses. From a geographic focus, we invest globally, but with a preference for Africa because most of our team is based in Africa. And from a stage perspective, we're looking at typically Series C and Series A transactions where businesses have around $50,000 of recurring revenue on a monthly basis. And we're investing between $500,000 and $2 million. But with that said, I've probably looked at close to 1,000 different startups in terms of funding applications. And what I'd like to share today, at least, is just, I haven't been an entrepreneur myself, so I can't say that I've felt the pain of going through this process on the other side. But if I was an entrepreneur and if I was looking for funding in South Africa, I'll focus on South Africa as the context. This is kind of the way I'd approach it. So yeah, let's get into it. I think through the discussion, what I'd like to just touch on is just a couple points. Firstly, the startup life cycle, which is kind of generally known, and why that's important is just so that, if you're as a startup or looking to raise funding, it's very important to understand where you are in your growth life cycle so that you can identify who you should be chatting to, what types of capital are available, and what the expectations are as a founder trying to raise capital. I think then we'll move and try and make it specific to the South African ecosystem, because I think the topic is raising funds in South Africa, but I think it's pretty applicable to businesses in the rest of Africa. And then once we understand the ecosystem, it would be good just to share some considerations that I think everyone should consider before they approach a funder. And most importantly, the concept of being investor ready. And then, finally, just touch on some key pitfalls that we've seen or I've seen founders make when they're trying to raise funding in South Africa. I think just to emphasize that I'll approach it from a kind of venture capital perspective, and that's mostly tech-enabled businesses. And that may mean that it's not 100% applicable to every type of business in South Africa, but I'll hopefully try and make it a bit more relevant. Cool. So just to kick off, I think the graph above just depicts what's kind of generally acceptable as a typical life cycle for an early stage business all the way until they potentially IPO. So, the x-axis is showing kind of stage of growth and maturity, and the y-axis is showing effectively level of revenue. And the kind of squiggly black line is just showing kind of profitability, which is effectively and how fast that business is growing. And then you'll see the bubbles just showing where there are different types of funders or funder characteristics that participate at different parts of the growth stage of a startup. I'm sure everyone on this call is pretty au fait with this diagram and this kind of characteristics, but I think what's the key concept here is that at each stage of a business's life cycle, there's obviously different levels of risk, moving from highest risk at initial concept all the way to pretty lower risk on the IPO side on the right-hand side. But what's important is that there's different funders participating in each kind of stage, and each funder has then their own requirements based on their stage of business. But as a founder, I would say what's most important is just understand where you sit in this life cycle so that you know the right person to approach when you're raising capital. And let's try and make this a bit more specific to the South African ecosystem or landscape, because that graphic is probably globally relevant, but not necessarily South African relevant. So this graph here just shows kind of a high-level research done by Andy SA around the South African funding ecosystem. I think it was in 2015. But what it kind of depicts is just that there are multiple different providers. Firstly, there are direct finance providers on the top side, and then there's capacity development providers, which are on the bottom side. And I think why that's important to highlight is that when you're raising funds as a South African startup or trying to scale, you should not only consider that direct finance options, and you should look at the capacity builders and providers that are available to you, because that should help you grow your business. We'll touch on some of the businesses that are in each life cycle, but I think the most important thing to note in this graphic is that you'll see, at the ideation stage or really early stage of a business, in South Africa, there is a big funding gap for those businesses. We are typically more risk averse as a South African funding ecosystem, and that's due to a couple reasons, but mostly the capital that's available to capital providers in the ecosystem are very risk averse. So generally, that means funders who are investing in startups have a certain risk tolerance, which is a lot lower than globally accepted kind of norms. And additionally, there is a very little amount of capital available in South Africa if you compare it to the global norm. I mean, I think year to date in South Africa, tech startups have raised around $750 million, whereas globally, I think the number is closer to $400 billion. So, 0.2% of the capital raised by South African startups versus globally just shows that there's a massive gap. And I think that's to do a lot with the maturity of the ecosystem and also the availability of capital. But why this is important to note is just that the concept of raising funding in South Africa and Africa for that reason is very difficult. So I don't envy any South African business or SME that is trying to raise capital in this market. It is very, very, very difficult. And you're not alone if you struggle to raise capital. But maybe just to kind of double click onto those different sectors and kind of the different pools of capital that are generally available at those stages. If we look at ideation or startup, typically where you would get some money to get your business off the ground, have a bit of MVP or minimal viable product to kind of test whether your customer is willing to pay for this is, I would say, firstly, family and friends. Probably in South Africa, that's not, most of the population isn't privileged enough to have a group of family or friends that have capital that can put into your business, but it may be possible. There's some crowdfunding opportunities. There's a lot of government institutions that have capital dedicated to supporting early stage businesses. Most importantly, there's incubators and ecosystem builders who are responsible for supporting and growing entrepreneurship in South Africa. And then there's other means of like corporate competitions, startup competitions that can give you grant funding to kind of help your business get off the line. But now once you've got a bit of product market fit, you're generating a bit of revenue, then you would typically start seeing yourself being in the startup or seeds kind of stage of business, where that's where early stage venture capital funds, angel investors and incubators are generally there to support you. And once you've moved through that, then you get into a growth phase where you've got a lot of traction and now you just need to kind of double down on your growth. And typically in South Africa, that's where more development finance institutions, later stage VCs, and probably earlier stage private equity organizations are there to support you. And then post that, there's more later stage private equity funders, more commercial banks and mezzanine providers. I think this just all has to do with risk, right? So your differing level of players just have different risk appetites, and that's kind of where they participate. I don't think we should kind of dive into too much detail here, but what I've kind of just tried to extract is just some like data or resources around, okay, like who are angel investors in South Africa, who are early stage venture capital funds in South Africa, who are private equity funds or crowdfunding resources that are available for South African or African startups to kind of use to see where they can get pools of capital. I think I'm happy to share this presentation, but what's most important is there's a lot of resources available online. If you just search for South African angels, for example, there's organizations like Josie Angels or ABAN, which is African Business Angel Network, Cape Town Angels, there's Dazzle Angels, which focuses on female businesses. So highlighting here is just that once you've identified what stage of business you're in, kind of what type of party you want to get funding from, there are resources available online to kind of find out who are those parties that you can kind of reach out to. Okay, now you've understood where you are as a business in your life cycle, you understand kind of what type of funders are available for you and what type of pools of capital are available for you. And now you're about to approach a funder for capital. Just some tips or key considerations that I would suggest that you think about, and I'm sure everyone here probably has thought about this already, but it's important. Firstly, like what type of business do you have? So do you have an asset-heavy business that needs to buy assets, or do you have a tech-enabled businesses that's a platform or marketplace that doesn't need much capital? Are you operating in an agri-tech sector, or are you operating in a fintech sector? Are you operating in healthcare, for example? Why that's important is because that will help you identify the type of funder you're looking for and also the type of capital that you can raise. For example, if you're operating in healthcare or education, there are a lot of pools of capital that are available to try and improve healthcare outcomes or improve educational outcomes that you should try and tap into, versus if you're a fintech, you're probably going to need more commercial type funding if that's not a development goal, for example, within the country. I think stage of business we've talked about. What type of capital do you require? Because I think that's a very important consideration, and I didn't talk about it earlier, but there's multiple forms of capital that you can raise. You can raise grant capital, you can raise equity capital, you can raise debt capital, you can raise some sort of convertible or hybrid of the 4 or 3. And why that's important is because you need to understand who gives you those types of capital and what are they expecting in return for that type of capital. So generally, earlier stage, probably grant. Moving on to higher risk is still equity for majority of the time, and then moving into debt at a later stage once the business is cash flow positive. Then you should probably consider industry fundraising resources, which I talked about. There's a lot of ecosystem maps and fundraising templates that are available for South African businesses to utilize to make the process easier for you. So I would suggest looking at resources like Brighter Bridges or Baobab Network, all South African resources that are very relevant. If you're trying to figure out templates to raise capital, look at a resource called Digital Collective Africa, which is a collective of South African venture capitalists who are trying to build templates to make this process easier. Then you should look at what other type of support do you need. So is there non-financial support? Because cash is great, but a lot of the time you need business building skills. And that's where a lot of the ecosystem incubators or accelerators in South Africa are very helpful. Types of Founders Factory Africa, Ingenie EdTech Accelerator, Startup Bootcamp, all of these types of accelerators and incubators help you build your business. And that's something to consider. I would say you also need to understand what type of capital you need to raise and what amount and what you're willing to give up for that. And maybe an important point is just, do you know anyone in your network that can introduce you to the type of person you're trying to reach? That's always going to get you further down the line than a cold call. And probably the most important thing is, or most important 2 points is, are you investor ready? So yes, you want to raise some capital, but there is a massive process and requirement on you as a funder to be investor ready in order to raise capital. And we'll touch on a bit of details on that later. But and the last point to consider, which most startups I've seen don't consider, is just, do you have the resource and capability to manage your business while you're fundraising? And do you have the timelines to do that? Because it's very unlikely you're going to say, I need to raise capital today, and you're going to raise it tomorrow. It's a lengthy process, takes a lot of time and resources. And I've seen a lot of businesses ultimately fail because fundraising in itself is a business. And if that takes you away from your core operations, it's normally has quite a negative impact on your business. Cool. So again, to just go through the journey, you know where you are as a business, you understand what type of capital you want, who you want to get capital to, you've considered all those things, and now you're about to approach someone to give you some capital. The most important thing before you approach any funder to give you capital is being investor ready. And this concept of investor readiness is basically just thinking about the funder's psyche and putting yourself in their head. So as a South African investor, and I'll speak about VC investment, there's a common misconception that we don't want to provide capital to startups, and it couldn't be anything further from the truth. I'm incentivized, my team is incentivized, VC investors are incentivized to deploy capital, to give funding to startups. And the reason for that is we've got a mandate, we need to deploy capital, and we need to make returns. So it's not that we don't want to give capital, it's just we need to allocate capital the best of our beliefs in order to meet our requirements. So if you can make that process easier for any investor, that will significantly increase your ability to raise capital. And how do you do that is by being investor ready. And there's two components of being investor ready: having resources, documents available that your investor is likely to ask for. And then the second part is just like understanding what an investor is looking for and what good looks like, so you can position yourself for that. I mean, I won't go through this in too much detail, but from a documentation perspective, I have yet to see a business successfully raise decent amount of capital other than friends and family without having a solid data room. And I know as an investor, if I ask if someone comes to me and asks for capital and they send me a link of their data room with all of these documents, I'm already inclined to want to fund them just because they've done the work in being prepared. I think it kind of goes for everything in life, but for raising capital, it's very important. So, I would suggest having a data room, and what that data room should include is a very clear and comprehensive pitch deck, a forecast financial model, which has at least a forecast period of 5 to 7 years, depending on what the funder's landscape or investment horizon is, having an organogram and your team CVs, because funders are effectively investing in a team at the earlier stages, having all your incorporation, regulatory documents, because that's something we would have to look at, showing your capitalization table or your shareholding structure, having some information on market sizing, providing your historic financial information and KPIs. And then from our side, from a tech perspective, definitely having your tech overview and product roadmap is something that we look for. I think everyone kind of understands it, but probably I'll spend a little bit more time on just explaining what, in our view as Newton partners and being in the industry for a little while, what we kind of look for and what good looks like. Because if you can understand what good looks like, then you can prepare yourself for that and make sure you improve your chances of raising capital. So I think the most important thing, and it's kind of a pitfall as well, is sometimes founders don't explain what their business does in the most granular and simple manner. So if you approach someone like myself and you operate in logistics, for example, I have no logistics background. Now you're telling me you're running a trucking business or trucking software business. It's very hard for me to get excited about your business if I really just don't understand what the problem is right now. So, explaining how the industry currently works, what the problem is, and then showing me what your solution does is probably the first 2 minutes of any conversation we have with startups. And that kind of determines whether we're interested or not, just by that kind of one point. Other things we look for is a large and growing market opportunity, because that increases the likelihood of success. Clear and evidence go-to-market strategy. So how are you going to acquire your customers and how are you going to go about that? Important is a repeatable sales cycle, so that we can assume that you have a process to sell to B2B customers or B2C customers, and that's repeatable. That's very important in the South African context, given that the corporate sales cycle is ridiculous in itself. Probably the most important thing we look for is just a diversified and technically strong and experienced founding team. Typically, I would say if we had to make it perfect, 3 founders, 1 from a technical background, i.e. technology build, 1 from like industry experience perspective, and then 1 person who's kind of just the CEO and strategic visionary. We look for strong founder incentives, so like large equity holdings in the business. We look for businesses that have strong competitive advantages, which allow you to gain customers from competitors as well as retain those customers, and not based solely on pricing. We look for founders who tell us exactly what they want and what they're going to use it for. Don't come to us and we want to raise capital. Okay, great. Like, how must I help you there? I want X amount. This is what X amount is going to be used for. And that's why X amount is going to get me to the next milestone, which is relevant. Another key important factor is just understanding what are the key drivers of your business. So yes, revenue is important, but what drives revenue? What are the levers that you can change that influence your ability to gain customers, increase revenue, retain customers, increase margins, that sort of thing? I think that's important. Naturally, the ability to show strong growth on revenue, financials, and non-financial information. Another point we look for deeply is just a team who understands their weaknesses and understands the gaps in their business. So we never expect a business to be perfect, but we find it very difficult to work with a team who believe they know everything and have no gaps, because if you believe that, then you're not going to focus on improving those gaps or solving the challenges that you have in your business. And then the last 2 points is having a strong network of advisors or investors already is always going to attract capital, and that's going to make it easier because we like to invest together and de-risk things. And then the last point, which is probably also really important, is it would be great if founders just understood general fundraising terms and understood what these general terms look like, so that when you are negotiating, that it's not a founder like taking a significant period of time just trying to upskill and not understanding that these are normal things that are asked for. Cool. So now that I've kind of told you what we generally look for and how to be investor ready, maybe I'll just touch on or close off on just some common pitfalls that I've seen South African founders, international founders, African founders do when they're raising capital. Probably the first one, I know it's not the first bullet, is just having an entitled mindset. I know that might sound condescending, but sometimes we get founders who come to us and say, we deserve your money, you owe us money. And that's never a great way to approach a founder, in my experience at least. Another pitfall is approaching investors who don't invest in your sector or don't invest in the stage of business that you have. And that requires a lot of research on your side, not being investor ready, we've mentioned, not having any knowledge of typical funding terms and round sizes and expectations, I think is important. I think something that founders do often is just rely on a single funder. So have a conversation with one funder, expect them to give you money. And if anyone on this call has tried to raise money from the large government organizations in the country, will quickly realize a lot of businesses die or go out of business waiting or going through a fundraising process with these organizations. And that's because it takes 12 months, 18 months, 24 months. And by putting all your eggs in one basket, you're effectively going to put your business at risk. So I always encourage founders to speak to as many funders that are available so that you can get the best opportunity for your business. And then not using or leveraging existing support structures other than capital. So like I mentioned, ecosystem players, ecosystem builders, accelerators, government competitions, corporate startup competitions. There's a lot of capital available. Then there's a lot of support that is available for you to leverage to kind of grow your business. So at a high level, that's kind of my view on a few points that are relevant to consider when you're trying to raise funding in South Africa or Africa. I'm happy to kind of take any questions either now or after this to provide a bit more clarity. Back to you, Keshni.
Wow, like I'm just gobsmacked by the amount of information that's come through, and I'm just sitting here nodding my head. I'm like, yes, that's so obvious. But you know what? To a lot of people, this is not obvious, right? It's things we take for granted, and as entrepreneurs, we tend to learn it on the go. And it becomes very difficult. So thank you so much for that. That was literally a loaded presentation. So what are we going to do? We're going to go into the panel discussion. I'm asking everybody, please drop your questions in the Q&A below, not the chat, because it may get mixed up. So please drop it in the Q&A below. We are going to get to it in a moment. For now, I'm going to ask the panelists to unmute themselves so that we can get going with our discussion. So Nivesh, one thing you brought up that came through very, like from get-go, was timing, right? Timing is everything when it comes to looking for funding. And if you go for funding at the wrong time, you can literally flatten your business. In your view, what are the top one or two questions that every founder should ask a VC or a funder who they're seeking investment from?
A good question. I think there's probably a lot, but I would say it's important to make sure the funder that you're bringing on board is aligned to what you want as a business, because although a good funder brings capital, you need value other than just capital, and you need to ensure that you bring the right partners on board. So first question I would ask if I was an entrepreneur is, what is your expectation from me as an investee company or capital recipient? What do you expect from me going forward? And how do you think we can work best together? Because you can quickly see what the expectations are, if there's any expectation gaps, and if you're aligned as parties, whether you can take a business one way or they want to take a business a completely different way. So that's probably the first question. Second question I would ask is, do you have more capital? And it may sound a little flippant, but a lot of the time you want to bring on capital providers who've got more cash and can provide you more cash later down the line. That's probably it from my side.
Great. Anybody else have any other questions? Like Zizipo, Kwame, is there any questions that you think a founder, a newly founder, or an established entrepreneur should be asking? Those are very good questions, by the way, because I when I went down that route, I tend to forget asking what's expected of me.
Yes, I think for me, the major thing that's important in funding is seeing your funder as a partner in growing your business, so that you are able to touch base with them and get advice when things go wrong. So understanding the mandate and the value, I think Nivesh has touched on that, the value that the funder will bring if they give you money. The money alone, often in my experience in SMME, is not solving everything. So it's important to understand the business support that you can get from that funder. When you are in trouble in times of COVID, you can't pay your suppliers, you need working capital urgently, or you can't pay your wages, you need money yesterday, your creditors are knocking at your door. You need to know that the investor, be it a shareholder or a loan provider, when you pick up the phone and you're saying something is wrong, they are going to have the best interest to make sure that the business doesn't fail, because if it fails, you won't give the return on investment that that investor is requiring. So understanding expectations from both sides is very important, and getting the support or an idea of the support that you will get when something goes wrong. Because believe you me, I've been an entrepreneur myself, and I am an entrepreneur while in corporate. Things do go wrong. It's not an easy journey.
Yeah, you're very right. We often think about all the best case scenarios and never actually cater for those things that could go wrong, because we want to stay positive about things, woosa. So it doesn't always work. Pami, from your side, do you have any?
Yeah, I think one question that is quite introspective when you're going into something like this, when you're going into this venture. A question you need to ask yourself is, do I have a product and or service and or solution that is going to sell? Is this something that people want? And before you actually go out and look for funders, look for capital, look for partners, ask yourself that question, put yourself in a customer's shoes, look at it from a customer's perspective, and then make the decision of whether this is a viable business for anybody to invest in. And coming from the environment where I literally started out with what was in my back pocket, and built quite a lucrative business on the back of it, I can honestly tell you that's not a question I asked myself. And only a few years into the business do you actually realize maybe this is something we should have asked ourselves in day one. So I think introspectively, take the time out, ask yourself the question, ask those around you, the people that are either starting up the business with you, family members, friends, colleagues. I like this initial slide that Nivesh put up there. The fools that believe in your idea, ask them those questions, and then take the next decision.
Yeah, you're right. You're so right. And again, that comes down to the wisdom that you build through all the mistakes you make along the journey. And it's always great to impart that on people that have never been through there and are just embarking on it. So I think that's extremely valuable. One of the things that also comes up again around timing is at what point would somebody understand this is the point I need to go for investing? I need to get an investor in. At what juncture do you think, or do any of I'm just going to open it up. Do you believe entrepreneurs should think about, okay, now I need funding? What are the kind of key light bulbs that go off besides I need to pay next month's rent, or you know
If I may start, if you don't
Okay,
mind,
go ahead for me.
I'll start. So I think one important factor that people seem to go into business with, and I'm not just talking about entrepreneurs, I'm talking about people that go into a new job, start a new path of their career or their life. They don't tend to, especially in today's day and age. 20 years ago, things were very different. But the question gets asked right up front is, can I start this business if I had the funding, right? So it kind of holds yourself back in the sense that I'm not going to do the next step. I'm not going to, all of those, the data room that Nivesh spoke about and getting yourself investor ready seems like a very, very daunting task for 99% of the entrepreneurs that are out there. So they then move over to that idea that let me get the funding, let me spend so much time and effort to go out and get the funding. And as again, rightly Nivesh said, you lose focus in the operational, running the operational side of your business. So my approach and my advice is run the business. If it's a one man, one customer, one product business, run the business. Use whatever you are getting out of that business, however you started it, to create a little bit of a nest egg for yourself, while at the same time in the back of your mind saying, I am going to be at the point where I can now start raising funding. Don't do it the other way around, because the moment you do it the other way around, you come up with that sense of entitlement mentality. You come up with the idea that I'm going to be the next best thing, that Silicon Valley has ever seen. And I got shot down by another VC friend of mine up in California. And he said to me straight out, dude, your idea is fantastic, but you're not going to make it in this environment. For every one that I see of you, I see 1,000 other guys. And they all got the same idea, and they all got the same opportunity that they want to create. So rather than asking yourself the question, when is the right time to go out for funding? Run the operation, run the business, get some revenue going, get some customers going, and then go out to the market and say, okay, right, I do have something that's viable. The market has shown me that it's viable. Let's see if I can get someone to fund it.
That's amazing, because revenue is always your best source of funding.
100%.
Always. Zizipo, you were about to say something?
Yes. So just to add on what Pomi is saying, so that's the startup. You're starting something from scratch. Perhaps there's a different type of business. I think Nivesh put it very nicely in terms of the life stages of a business. An entrepreneur might see an opportunity and want to acquire a business that's already existing. There, you have to be able to get funding to buy that business. But what is important for funders is that you have to show skin in the game. So if you are knocking at people's doors and saying, here is a manufacturing plant, I want to buy it first. Do you have the skills to run the manufacturing plant? Do you have the right team around you? Or do you think you're going to run it as a one-man show? So technical expertise, business development skills, and understanding the business model and financial model of that business. So what Nivesh was talking to earlier around being investor ready, sometimes entrepreneurs don't necessarily need funding. They need to understand what is in front of them and then plug in the gaps. Funding may be one of those gaps, but it's not the only thing that will help you go ahead. So I think it's important to really familiarize yourself with the mandate of all these funders that are available, and also identifying whether you need a loan or you need equity. If you think you need equity, are you going to be able to handle the shareholders that are coming on board? What value should they bring? How are you going to manage the relationship? What is the growth plan? So I think I do agree to the point that people often use access to funding as a barrier of entry into entrepreneurship. There's a number of other ingredients that are required to make entrepreneurship successful. So that life cycle that was highlighted earlier, please have a look at that and see where you are as an entrepreneur. Sometimes you may go well with a shoestring budget and only get funding later on when you want to expand and when you can repay the loan because you can generate enough cash to pay the loan. Sometimes you may only need grant funding because your stage is where there's too much risk. You want to use a funding instrument that doesn't require you to repay. So I really encourage entrepreneurs to assess those things before going to funders and looking for money.
Thank you, Zizipo. I think the one thing that stood out for me especially was are you the right person to do this? Do you have the skills to do it? And it's the Kruger-Dunning theory. Some people overestimate their skills, while others underestimate their skills. So it's a fine balance, and it's also getting that external feedback from people probably that you don't like or don't like you to give you the truth of who you are and what you're capable of.
Yeah, just one last thing I want to add, Keshni. I always say to myself and to entrepreneurs, is the problem I'm solving profitable? Is it making money? You might be passionate about knitting jerseys all your life, but the jerseys, are they making you money? Or the cups that you like, are they making you money? The business that you are in, is it making money or is it just a hobby?
Yeah, follow the money. So we are drawing very close to 7 o'clock, and I don't want to waste time on the panel questions because there's a lot of interesting questions that have come through on the Q&A, which I'd like to dive into. Adi has a question for just give me 2 seconds. For Nivesh. To what extent would Newtown Partners work with social enterprise to secure startup funding? Would funders be interested in investing for social impact and branding rather than profit? Wow, that's a tough question.
Great question. I think, again, it's just important to understand who the funder or who the capital provider that you're looking to partner with is and what their objectives and mandate is. So from a Newtown perspective, our capital requirements or mandate requirements are to be for profit and invest in profit. Although from a personal perspective and from a team perspective, we're very aligned with impact related startups and creating positive and social impact as well as returns. To answer the question around, are there funders that would support you? Yes, there is a massive amount of impact investment capital available that is there to support businesses in creating positive social environmental impact. And there's multiple different structures around that. So the answer is yes from a other perspective, but not necessarily Newtown perspective.
Thank you. Sorry, I've been a switch screening problem. The next question was from Kyle Reddy. How much equity should one give away when raising funding for in the first round?
I'll take a little bit of that, if I may. If you ask any entrepreneur, they're going to say none. I want all the money. I'm not giving you anything, right? And I think as being in business in South Africa is very complex and it's very difficult right now. Everybody knows that it's not easy making money in this country. When you do have business that is coming in, the idea of giving a little piece of that pie away is at the very back of everybody's mind. But I think when it comes to funding, whether as a VC, whether as a business owner, whether you want to bring a partner in, it's horses for courses, right? Depending on how much you feel would benefit the business. And at the same time, be attractive enough for the funders to get something out of it at the end of the day, right? If you're going to go out to a funder, a team, the Founder Institute, us as mentors, and you can come to us, listen, I'm valuing my business at 100 million Rand, and I'm willing to give you 2.5% of that. there's going to be a lot of questions. We can ask a hell of a lot of questions. So those questions are what you need to be asking yourself in terms of that, what you want to find out, Kyle. The amount of equity needs to be specific to what it is you want to do with it. It needs to be specific to the business and the idea that you are trying to sell. If it's an existing business, as Zipo said, that you are trying to get funding on in order to continue that business, it's quite a lucrative thing for funders to be able to invest in a business that is already making money. So then you might entice them with giving a slightly smaller piece of the pie as opposed to a bigger piece of the pie. So again, I think, working with people that are doing this on a daily, weekly basis, working with us as mentors will give you some insight into where you should be pitching that. But right off the bat, any entrepreneur can say, hey, 1% is too much. So I'll give nothing, but just give me the money.
I think I wish it was that easy, usually from an investor's perspective.
Absolutely.
Zizipo, do you want to weigh in on that?
There's a phrase that I like, is to say that 100% of zero is zero, right? Would you rather have 100% of nothing? So I really want to urge entrepreneurs, as much as it's scary to give a share of your idea, but it's a give and take. I think Pomi covered it really well. It's a give and take. You really shouldn't be scared. And more heads work better than one. So that shareholder, just make sure though that there is value that they are bringing, and it's crystallized as to what exactly are they bringing to the table if they're going to take a percentage of your business.
Thank you. Nivesh, you look a bit concerned.
No, maybe just to wrap up, I think Zizipo and Pomi mentioned it, like it all depends. And this is always a question that is very common, right? Like how much equity do I give away at each stage? How do I know funders isn't taking advantage of me? Normally it's the other way. The expectation is probably too high from an entrepreneur's perspective. But what might help, Carl, is around the world, there are typical ranges at each stage of business. So we talked about that life cycle. Typically a business could go through 7 or 8 funding rounds from the time it starts up until Series B or Series C in venture funding. And typically there are average amounts that are raised at each stage. So pre-seed round is typically $500,000 to $1 million, and typical dilution or equity sale is around 10 to 20%. So there are resources available around the rest of the world, mostly around typical equity amounts to give up, and depending on how much you're raising and stage of business. So you can have a look at that, but again, it just depends on a lot of factors.
Yeah, thank you. Yeah, this is such a broad topic that I think we could go on the whole night talking about it. Right? There's so many questions also coming up, so I'm gonna choose kind of the best out of all of these. From Sean Bosman, how much equity should you offer someone to assist you in acquiring funding, or what sort of remuneration should you offer someone assisting in this process? As you said, finding funding is basically a full-time job and a highly specialized skill. Wow. So that for me is a big red flag. But let's open it up. Who wants to take this one?
I'll take it. For me, it's important to understand it's a service, right? So firstly, let me just say, you can't be good at everything. So it is expected that you might know what business you want to get into, or you are in, but you might not have the skill of capital raising, and therefore you get an expert to help you in that. But it's also important to understand the terms and expectations upfront. It's a service. It might be as simple as paying a service fee for the person to raise capital for you. Other people will base the payment on a success fee. English is not my language, but you get what I'm saying. So if you're successful, you get paid based on success. The issue of shareholding, from my experience, is probably rare. I don't know if my colleagues share a different view. it is a service that you are providing. Unless the person is going to play a meaningful role other than raising capital in running that business, I don't see how shareholding becomes part of the discussion.
Yeah, I agree. 100%.
Maybe I can just add on to Zisipo's point there. For sure, I agree. It's a service, and typically, I would say, yes, it's very helpful to have an advisor because, like we said, different skill sets. It's important to make sure that you're well positioned, because a lot of the time, if you're not positioned well to go to a funder, and then you go and get an advisor and then go back to the funder, there's already a preconceived idea of how we feel about you. So it's unlikely that that will change or your capital raising will be successful. But yes, either you can pay a fee. I have seen a lot of providers of advisory services start asking for equity, which is quite common. And that's normally because your startup can't pay these large advisory fees, right, that are normally associated with the kind of skill level of the person helping you. And there is a, like Zisipo said, a success fee that comes with it. I would kind of disagree and say it's probably better that you offer equity in terms of startup capital raising than just a fee, because that means your advisor that's helping you is incentivized to ensure that you raise capital at the right amount, at a strong valuation, and get the right funders on board, because their value is tied to your value as the business, which kind of just aligns your interests a little bit. Obviously, you don't want to give up a lot. I've typically seen equity stakes given up in lieu of advisory services ranging between 2 to 5%, in my experience.
Thank you, Nivesh, because that was actually going to be a question from me. If you're going to give up equity, how much should you be giving up? Because by that stage, you need to understand the value of your business. So it is quite a complicated matter to actually think about. The next question comes from Maggie Gianna. What advice or warnings would you share to entrepreneurs to look out for when approaching funders? Are there clear red flags that entrepreneurs should look out for when negotiating with funders? Oh, this is such a hot topic as well. That can, I think, be a whole nother 2-hour discussion. So, do you want to take that, Nivesh?
Sure, I'm sure the other panelists will have better views than me because I'm slightly biased being on the funder side. But biggest red flag is if the person you're negotiating with or speaking to keeps moving the goalposts. That often is a red flag in terms of they might not be the decision maker. They may not really be that interested. And if they keep changing the goalpost and a lot of the time negotiating on different terms consistently, that's probably not a partner you want to get into bed with. And a lot of the time they're just trying to take advantage of you. So if the longer the process takes, the less capital you have and the more power the funder has a lot of the time, and they can take advantage of that, i.e. they'll give you bad terms and you have to take it because now you have no other choice. So yeah, I would avoid that. And maybe a key way to test that is chat to other funders, like chat to other people and check the reputation of the person you're dealing with, because that's the most important thing. Everyone else kind of has had bad experiences or good experiences and can give you better views.
Yeah, I will just add to that. I think, interview your funders like you interview your staff. Find out what their track record is, find out who they've done in and who they haven't. And if you get to the point where you start uncovering from third parties, from people that have invested in, from companies that have invested in that have gone bust, more importantly, find out what the reasons were. Was it due to anything that the funder and or the investor had to do with, or was it something fundamentally that changed in the business model? So, my advice would be to interview them, get as much information and research about the funders as possible. And once you have that information, you can make an informed decision. And you can actually develop, Maggie, you can develop your own 4 criteria of what you feel are the characteristics that makes the funder suitable to you. Because you might find a funder out there that is very focused on tech, but you're running a health and wellness business, like somebody else mentioned in the chat, in the Q&A. So, maybe that particular funder is just not a good fit for you. So the characteristics will change depending on what it is you're looking for. Go out, interview them, get as much research about it as well.
I agree with my fellow panelists. I just want to add that this thing of wanting to be jack of all trades sometimes cripples entrepreneurs. In addition to what has been said, if you are unsure about the agreement that is in front of you, get a lawyer if you're not a lawyer to look at it. Get someone who understands commercial terms to unpack this thing. Sometimes entrepreneurs get to funders at the very last minute and they are desperate to get funding, and then only realize that they've signed terms that are not favorable to them when something hits the fan. And there is no turning back. You've already signed the paper and you are now trying to negotiate exit clauses and you're trying to negotiate payment terms. You are unable to, because you were desperate when you were busy signing these things and you didn't look at them and you didn't seek advice of a person who understands the legal agreements, the commercial terms, and make sure that you get into this partnership with excitement, but with also divorce at the back of your mind. When something goes wrong, it really, really goes wrong.
Can I just add to that? Even if you do know what you are doing in terms of this partnership and this funding, get proper contracts and agreements in place. You know, we've got fellow mentors at the Founding Institute that are doing this as a business because they realize when you actually get down to the point of doing those agreements, do it on day one. You know, you don't sign your prenup agreement after you get married, right? So do it on day one and try and get that done as much as possible, because yes, it'll get to the point where you're going to start arguing and you're going to start fighting with the partners and the funders or whatever. At least you have your contracts in place. Keshni, I do want to, I noticed that there was a question that I do want to answer, if you don't mind, if I could answer it live.
Yeah, sure.
So David Warren has said, if you want to do it.
No, sorry. I just want to be cognizant of time as well.
Sure. Just very quickly, 2-minute
Go for it.
answer. David Warren's question is, my problem is that I need investment to convert my manual process into a computer tech solution. This will distinguish me and make me a viable solution. Without the tech, I'm just an employee. Therefore, my monthly turnover is not sufficient to attract investor interest. Just 2 things, David, that you need to be aware of. You could actually contract this out to somebody else as a service and negotiate with them to be able to tech enable your service or your solution over a period of time. It doesn't have to be a CapEx purchase. You don't have to outlay cash to be able to do that. You can get people to actually do that over a period of time. But more importantly, I'm going to say something that might be a little bit controversial. If you are at the point that you have a solution where the monthly turnover currently is not enough to sustain the solution, you need to ask yourself the question that if you do tech enable it, will it have the monthly turnover to be able to sustain that business? It's a very, very important question. I've been through this, launched cloud businesses. We know exactly what we're talking about when it comes to this. Make sure you know that it is going to work for you, and then you can go out and look for the funding.
Cash is king. Cash is always king.
Always.
Yeah, always. So yeah, going back to the previous question as well. Thank you, Pommy.
Sure.
The goalposts, you know, in order to know that the goalposts are not moving, make sure that you know what you want from the VC, right? DD the funder, we hardly ever do that. We hardly ever do that, you know, because we don't expect people to be thinking, they just get all excited. I'm in front of a funder, so I need to just jump, and you know, it's not that. They, as much as they interviewing you interviewing them to find the correct fit. And lawyers, yes, when you get into any deal, you got to think about what's going to happen when you leave. What's your exit strategy? What's the divorce papers going to look like? You know, that anti-nuptial has to be, like in a marriage, signed way before you sign, when you get into bed with them and have little kids. You know, it really is that close to life. And Pommy will tell you in the networking session afterwards how stress of a business can literally kill you. So meet them in the Air Meet room after this. Thank you. I'd like to really thank the panelists. There are so many questions that came up that are of value. And I can't thank you enough for our attendees. Wow. Thank you. Thank you for the participation. Thank you for being here. Thank you for making this a success. To Zizipo, Nivesh, Pommy, this was absolutely fantastic. Like I said, I could talk to you guys the whole night about funding and about investing, but we don't have the whole night. So thank you. Thank you for your time, for imparting your wisdom and your knowledge. I know there's a lot more that needs to be understood, and this webinar is just, again, the time is just insufficient. to bring justice to the kind of knowledge and wisdom you bring to the table. To the team that's supporting me in the back end, thank you so much for making this evening a success. We are much blessed to be in this space where we get to work together and collaborate to launch our next cohort starting in 2022. So to the founders that are out there, those that are looking to get into the accelerator, applications are open. Bumzile would have posted the links, all the relevant links into the chat for you. We'll leave the webinar running for a few minutes after we end, just so that you can get those links, copy it quickly, and get going on your applications. So, wow, that was a lot. I'm out of breath, people. Really, I am out of breath. So, again, I bid you farewell. Let's meet on AirMeet. You'll get the link in the chat below. You'll get to talk to our panelists. You'll get to ask them candid questions, and you're going to get personal. So you're going to get to ask them face to face, or well, as close to face you're going to get. Right. So again, thank you all for your time. I bid you guys a wonderful evening, and we have a few webinars coming up. So keep an eye on our pages on LinkedIn, and as well as the website to sign up for those webinars. And I promise you, you are going to be blown away as you are tonight. Thank you again.
Thank you, everyone.
Thanks.
Bye.